Anthropos, welcome everybody to Economica, all about economics and finance, and welcome everybody into 2026. If you are new around here, please subscribe to my channel. You will find the best of the macroeconometrics research and everything in between for financial assets. So what do I got today? Something very quick, very fast, very interesting. Nobody has noticed, because of the government shutdown, that the unemployment rate also in the United States has been ticking up. And what ticks me off is that we didn't have data because of the government shutdown, but slowly the Q2 unemployment rate, it went from 4.1% to 4.6%. These are the rough data that we got from the Bureau of Labor Statistics. Now the question is, perhaps what is the break-even level of payrolls to keep the unemployment rate stable? But my question is instead, what is the break-even level at which the banking sector starts to get into a credit crunch? And we got the answers. So what's gonna happen? I say the Chicago Fed estimated that also in December unemployment was 4.6%. Let's take it 4.6%. Let's hope, perhaps, fingers crossed, that we will get some data from the BLS if they are allowed to do anything. If they are allowed to do any job. If they are out of work, they're out of work. We will not have any data, but perhaps we will have more unemployment. However, what we have estimated is that in all 2025 there has been an average of 271,000 payroll job losses, which is amazing. You know, something happens, something in the air, and then a Trump, and the whole air changes. So another data that has been estimated in all these, perhaps, however, whatever, is that there has been an average of 17,000 jobs created per month. So the pace of job creation has slowed a lot. Not too much, not too fast, not too slow, but perhaps it has slowed somehow, somewhat. And don't you worry about a thing, because there is AI is gonna save the world from everything. AI does everything. It does coffee, it does pizza, it does Starbucks, it does your oat milk white latte with caramel and cinnamon, pumpkin spice, whatever. It does everything. So it doesn't matter. You don't need to create jobs. We are all fine with AI. AI is the future. We are going to live. AI is gonna cook for us. It's gonna do cookies. It's gonna do giant cookies. It's gonna do lollipops. It's gonna do top of the pops. Everything is gonna pop, perhaps. So the average job creation has been 17,000, and according to the rough model that I put together, is that on average, to keep the boat as it is afloat going, you need a net 20k jobs per month. What that means is that between the payroll created and the job losses, to keep the labor market afloat on a steady base, you need a net 20,000 jobs per month. But on the other end, we have that the gross figure, whenever the overall payrolls created per month are less than 246,000 on a gross basis, without netting for the job losses. So below the 246,000, it's likely that the unemployment rate, it can increase, even though there are 200,000 jobs created. It depends on the netting effect for the whole labor market. But what that means is that to see the unemployment rate decreasing downwards from the level where it is now, 4.6, down back to 4.4, etc., 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 you will need a massive acceleration in payroll growth of north of 150,000 to north of 250k, 350k per month, which I don't see how this is going to materialize in any shape or form. So what or where is the crunch point? And the crunch point is 5.6%. Yes, you are a millionaire. So whenever the unemployment rate starts to go above 5, whether it's the United States or perhaps in the UK where already is at 5%, then that becomes a concerning factor for credit markets. We can consider a plausible risk scenario whether the unemployment rate would slowly increase to 5.5%. All it takes is about 600,000 jobs to be gone out of the window, and of course it's very difficult to figure out what is the pace of change of the job market, whether more payrolls are created or there are more payrolls that are shredded. Here we have very linear scenario, 100,000 of job losses, and in 6 months you get to 5.5%. But I think that we can argue, for example, if we decreased from 100k to 50k, it will take 12 months for the unemployment rate to get to 5.5%, which it can be recognized as a warning level for the whole banking system, the credit system, at which some distress it can be created. It can become an outcome of the rising unemployment rate. And so we know on a broader basis that the overall household debt is 18.5 trillion. It's not, it's just 18.5 trillion, there's nothing to worry about, which 13 trillion is in mortgages. So it's all perfectly fine, don't you worry, it's all fine. But anyway, what I would rather argue for all the strategies in general, the macroeconomic strategies, all the hedge funds and the banking strategies and all the stock, they will rise and whatever is going to happen. You just be aware if the job market in the United States is going to take the same direction or the same features of the British, of the UK job market. Well, guys, you that are on the other side of the Atlantic, you are in big trouble, guys. If the job market in the United States is gonna take the same direction or the same features of the job market in the UK, then you are in trouble, guys, because it's easy, it's gonna get to 5% and more than 5%. So the banks, they're gonna be quite concerned. So all we can gather here is that not 5.6% is the crunch level, and the critical level for the job losses would be around 9.5% in unemployment rate. That would be a credit crunch event, and you have, of course, you have a feedback loop multiplier in the credit tightening and a whole downside risk for the stock market, so forth and so on. You have a wonderful, not so wonderful wealth effect, because if the economy starts to slow down and you have more people which are unemployed, then all sorts of bank assets, which are credit cards, consumer loans, mortgages, they start to go concern. But on top of that, you have another wonderful thing, which is the wealth management side of thing. All those wonderful wealthy people who have borrowed against their stock portfolios, and when their collateral, which is their stock portfolio, starts to lose value, and then the wealth management, some Mr. Margin Call will pick up the phone and say, okay, Mr. Smith, good morning. You know that your stock portfolio has gone underwater. Do you have some money to top it up? And that will be all sorts of very funny, concerning things that will go on into the market. But of course, this will never happen because AI is going to save us whole. But anyway, I'm not just playing the clown, because the Federal Reserve itself has implemented a stress test scenario with quite severe unemployment rate, peaking at 10%, way more than this. And they have been able to some sort of find out that not anyone will survive unscathed, but that the banking sector will eventually be able to survive that kind of severe credit crunch scenario. Now, that would be very interesting to find out, at least to go and read the outcome of this stress test. I think it will be very, for sure, that will be very informative. But already they have some levels of critical levels which are around 6.5-7% unemployment rate. And I want to stress you and remind you all that we are starting from 4.6%. Now, I say the total debt of households is 18.5 trillion. It's nothing. It's nuts. It's everything is fine. And what it's likely to what are likely to be the most sensitive sector, of course, are those with low quality credit underwriting, which of course are auto loans and credit cards. But the distribution of the going concern will be mortgages north 12%. Of course, this is eventually this in real time scenario, if effectively you will have a severe deterioration in the economy, but if the United States economy decelerates, so in a crisis mode, then the whole global economy goes haywire. So it's not something that it's isolated, but then the losses are not the losses, but the deterioration in the credit, in the asset side of banks, which is critical, is the asset side of banks, because banks, they earn from the mortgages that they issue, so forth and so on. That would be real fun indeed, and the wealth effect would be even more interesting. Anyways, so I cannot eventually see the future, and I'm sure that everything is gonna be fine, and the stock market will do very well in 2026. But be aware that we are just only 1 percentage point from some critical level in the unemployment rate, which can start not a domino effect, but it will start to affect the quality of banking assets, and then the constraints. Then it will eventually be also a factor for credit tightening for the consumers, the ordinary retail bank customer, and then down the line the whole economy slows down even further. So we start a feedback loop of slowing credit availability, tightening in credit. There are parts of credit which are outstanding, which will go concern, and so forth and so on. So the Fed has done its stress test scenario: 10% unemployment, 30% housing prices down, everything is fine. Don't you worry about the thing, because AI is gonna save us all in 2026. We will see what's gonna be the unemployment rate. I think we're going to have so much fun if the unemployment rate in the United States will start to resemble the UK unemployment rate. That would be so much fun. Such fun. That would be amazing. So I have to love you and leave you, dear friends, and please stay with O Economica. We will have a wonderful year, and I will provide you the best of macroeconometrics and everything in between. Enjoy the new year.